I sold Yoga Stay along with 3 other brands that in total had done about $25 million in sales. These are the 7 main lessons I learned from selling a multiple 7-figure e-commerce business. So if you're interested in trying to sell your own business someday, these are some things you might want to watch out for. And lesson number 1 is, when is the right time to sell? Back when I was running my business, I thought that whenever I decided I wanted to sell, I would be able to just flip a switch and buyers would appear and it would be all fine and dandy. And what I learned was that couldn't be further from the truth. The minimum amount of time that you want to be running your business is at least 1 to 2 years. So 12 to 24 months. The reason for this is that it gives buyers enough of a track record to look at in your business to then be able to future forecast out what they could reasonably expect the business to do in the future. And that's where largely the valuation of the business will come from. So the first part of that is duration. The other part is when your sales are diversified enough that you're not just getting all of your business from one channel, like everything from Facebook or everything from Google, which is the spot that we were in. At first, when I wanted to sell, we were primarily like 90% Facebook ads. And in order for us to be a real viable business that buyers would be interested in, I had to diversify us across multiple channels. And then the last thing that tells you if you are at the right point to sell is when the business is able to run at least semi-autonomously, meaning that you could step out of the business and it would still continue to operate and grow without you. And the reason for that is that buyers want to be investing in assets. They don't want to be investing in buying a job for themselves, essentially. And when I was running Yoga Stay, at the beginning, I just had essentially a glorified job. I was effectively self-employed. Sure, it was an LLC. It was a business technically, but since myself and my business partner were doing everything, we didn't have an asset that a buyer would be able to just acquire and then expect it to grow. They would need to buy it and then operate it. So the right time to sell is after you've been running for at least 12 to 24 months. You have somewhat diversified streams of revenue, at least 2 to 3, and your business is able to operate semi-autonomously without you. The second big lesson I learned is, what are the things you need in order to sell your business? The first one is really clear financials. And our business had been around for several years at the time that we decided to sell, and we had done a terrible job of keeping track of things. So you need to have your profit and loss broken down month by month for the entire history of the business. Second, you need a balance sheet that shows all of the liabilities and the assets within the company. And you need to know these things cold. You need to know them inside and out, all the dips and spikes. You need to be able to explain all of that to a buyer, because they're going to look at this with extreme scrutiny later on in the process. The second thing you need is a slide deck, and this is not required, but it definitely helped us out a lot. And the slide deck is basically a PowerPoint presentation that outlines your business, the pros and cons, and tries to give a aesthetic representation of the business. Like, give something for the visual learners, visual buyers to like really picture. You can make pretty like line graphs and charts and show pictures of your products. And this really helped us out a lot. We spent a lot of time making a deck. And before we had a deck, we were getting very few leads, like very little buyer interest. And then after we invested probably 20 or 30 hours into making it, the amount of leads we had and interested buyers definitely spiked. The third thing I learned from selling my business is, what are the best places to sell your business or find buyers? I thought that if I build it, they will come and buyers will just be knocking on my door. And that couldn't be further from the truth. In reality, there's 3 main options. Number 1 is exchanges like Shopify Exchange, which is no longer around anymore. Number 2 is finding a broker or a banker. And third is just selling it yourself, direct to buyer. You act as your own broker. And to cut to the chase, if you're brand new to the process of selling a business, I would honestly recommend going with a business broker, because they have a whole list of leads of potential business buyers that they've worked with in the past that they will then shop your deal around to. And they can help you get from deciding to sell to close much faster than you doing it by yourself. The only downside, obviously, is they will take a commission. These can range greatly depending on the value of your business, the deal size, and what you negotiate with them. But a typical percentage is anywhere from 5 to 15, even 20%. But it can be well worth it if you have zero experience with selling a business. And that's what we ended up doing. Since we had never sold a business before, we hired a broker and worked with them to, 1, craft our offering memorandum, which is basically an overview of the business, clean up all the financials, and they helped out a little bit with the pitch deck. And lastly, they were huge in the marketing side of things, finding the leads and getting us on the phones with potential buyers. The fourth lesson I learned, which was a huge shock to me, is how much can you actually expect to sell your business for? Now, Value is a subjective subject, but there are some good benchmarks in the business world. Now let's break that down, and what does that mean? When you go to sell a business, the value of your business is normally determined based on a multiple of your trailing 12 EBITDA, which EBITDA just means earnings before interest, taxes, depreciation, and amortization. Basically a fancy word for what is your net profit. And my expectation going into this was that we'd be looking at a 4 to 5x on our trailing 12 profit, which we ended up about half of that at the end of the day. The multiple you can expect goes up exponentially depending on the size of your business. And 2 million in EBITDA is the threshold that things really jump up to just another bracket. And we were well below that at the end of the day with our net income. So we ended up in the 2.5 to 3x multiple range. So for example, if our trailing 12 was 500,000 in net income, like bottom line after all expenses, we would be looking at about $1 million to $1.5 million in a purchase price. And another thing that factors in heavily to what kind of multiple you can expect, which again, these can range anywhere from a 2 to a 5, 6, or 7x, is number one, the size of your business, but number two is your growth rate. Buyers obviously want to be investing in acquiring businesses that have good projections and are expected to grow year over year into the future. An ideal growth rate, from what I've learned, is anywhere from 15 to 20% year over year growth. And if you're flatlined, or even worse yet, declining, you will take a major hit on your multiple, because you're essentially selling a sinking ship or a melting ice cube, and nobody really wants to invest in that. So going back to our earlier point about when is the best time to sell, time when you have increasing revenues year over year is far better than a time where you are stagnant or even decreasing. And the fifth lesson I learned about selling a business is the importance of building rapport when you're meeting with buyers. I expected it to be far more transactional. Just if we have the numbers to back up what we're saying and the buyer's interested, then you end up closing the deal. What I realized after going through this process is that it is far more interpersonal and about your people skills than anything else. Because the way that it works is you list your business for sale. People will reach out, say they're interested. You will email them back and forth, answering some preliminary questions, and then you'll get on a phone call with them. Normally a Zoom, like video chat. And this is where it's super important to be able to build rapport with the buyer like you would with any other networking event or sales call. Understand like what are their goals? What are they trying to do? Like why does the business acquisition make sense for them? And really build a relationship with them. Because at the end of the day, selling the business is important, but you also want to make sure that you're doing right by the person that you're selling it to. And the most important part about all of this is the transparency. Transparency is absolutely key when it comes to selling your business, especially once you get to the face-to-face meetings, because this is the point where you have to be able to look the buyer in the eye and tell them that everything that you're saying about the business is absolutely true. And you need to do that, one, because it's the right thing to do, two, because if the buyer closes with you and they end up running the business and finding out later on down the road that they're not going to be successful because of something you left out, it's going to lead to a bad situation. And three, they're going to find out everything in due diligence anyway, which that's the sixth lesson I learned was about due diligence. And this is the process that happens after you've agreed to close with a buyer. They then get the opportunity to basically look under the hood of your business and make sure that everything checks out the way that you said it did. They're going to be looking at all of your bank statements, supplier invoices, marketing spend, your P&Ls, your tax returns if they ask for them. And luckily, you should be fine at this point in the process if you've been fully transparent leading up to it. Now, there will be some caveats, like there will be buyers that are just looking for any little thing that, even though you did disclose it, they try to blow it up and make it seem more important than it is and try to take a haircut off of the purchase price. So there will be some cases like that, but in my experience, due diligence, it can be a relatively painless process if you are willing to work with the buyer, give them everything they need up front, and answer any questions they have in a timely manner. And this process normally takes anywhere from 1 to 2 weeks, depending on how quickly the buyer is trying to work, and shouldn't be that big of a deal if you have all of your financials in order from earlier in the process. Which brings us to the seventh and last lesson that I learned from this process, which is the deal structure, closing, and post-close transition. Now first, the deal structure, there's a couple of different ways that a deal like this can be structured. The most advantageous, obviously, for the seller is just cash up front, cash at close, asset sale of the business or the brand. And when I say asset sale, there's two different types. There's asset sale and stock sale. A stock sale is when the buyer literally buys the LLC or they buy the entity and they're buying shares of that LLC, meaning they would take over control of all the bank accounts, credit cards, literally everything. What we did was something called an asset sale, which basically means that they are buying the brand, and which is a little bit easier tax-wise when it comes to those implications. But we did an asset sale and then just a mixture of cash up front and earnout. And an earnout is a really common thing that buyers will try to get worked into the contracts because it's essentially aligning the interest. So it's saying that, yes, we'll give you this percent up front, which can be anywhere from 50 to 90 or even 100 if it's all cash. And then a percentage of that will be the earnout, meaning that if certain goals or benchmarks are hit over the next 12, 24, 36 months within the business, then the seller earns an extra cash amount, which sounds all well and good, but something I learned is that anytime there's an earnout in the deal, you should always make the deal with the thought in mind that the earnout will never happen. And if the earnout never happened, would you still be happy with the deal? Would you still want to do it? And if the answer is yes, then great, go ahead and do the deal. But if that's not the case, then you should really take a step back and think about things, because even with the best of intentions on both sides, there's a chance that it won't happen, and you just need to be prepared for that. Let's say you've gone through due diligence, you've come to the deal terms that everybody agrees to, and you've closed. The money hits the bank account. It's a great feeling. Now what? The first step was we start transitioning all of our accounts and changing passwords and that sort of thing, giving them complete control of everything. And then we start the transition process, which this is something that can vary greatly depending on the deal. Again, this will be hashed out in the negotiation stage. But what is the transition process or training or onboarding that you're expected to give to the buyer and the buyer's team? So this normally includes a set time schedule of anywhere from 4 to 12 weeks, entirely depending on the size and complexity of the business. And for me personally, transition period is the time that I like to make sure that the buyer is getting the most bang for their buck out of the deal. Like, at the end of the day, business is all about people, and I want to make sure that any deal that I do leaves a positive impact on the world, as corny as that may sound. So I want to really make sure that they have everything they need to possibly succeed. I can feel like I genuinely did my best to make sure that the deal was a win. Then once the transition's over, it's up to you what you want to do. Start a new business, start a YouTube channel. But my personal advice would be to take a break, take a step back. As entrepreneurs, our first inclination is normally to just jump right into the next thing, and as mine was too. But I think it's really healthy to be able to take a step back and relax before jumping right into the next business. And there you have it. Those are the 7 lessons I learned from selling a 7-figure e-commerce brand. I hope you enjoyed this and learned something. If you have any questions, please feel free to let me know in the comment section down below. And thanks for watching. I'll see you in the next video.